Welcome back to the Wealth Talks podcast. This is episode 587. And in this episode, we want to talk about how do you calculate how much death benefit you need. Life insurance is most commonly known for its death benefit. Now, those of us that use life insurance for infinite banking purposes, we are primarily concerned with capital that we have access to during our lifetime when we're thinking about infinite banking specifically. The death benefit is a very important part of the whole life insurance that we buy to use with infinite banking, but usually our focus is more on the cash value or the living benefits of the life insurance policy than it is the death benefit. I'm not going to say that we overlook the death benefit in our work with infinite banking or when we're focusing on infinite banking, because that wouldn't be true. The death benefit is an integral part of the policy. It's very important for calculating how much money you can borrow against your life insurance policy. It's important for calculating your share in the dividend. It's also important for securing that loan that you have from the insurance company, securing any policy loan. And it is also there as a just in case to take care of your family, your loved ones, and that kind of thing. It's also extremely helpful in not letting the government dip its fingers too deep into your estate when you want to pass money on to your heirs. So there are tax benefits that come along with the death benefit. However, as Nelson Nash writes in his book, The Infinite Banking Concept, your need for finance is much greater during your lifetime. And that's the reason that we generally focus on the life benefits of a policy. We want to make sure that when a policy is designed for infinite banking, it has good cash value right away, and that cash value grows quickly because your need for finance during your lifetime is very great indeed. The more of your financial needs that you can handle with your policy, with your infinite banking system, with the banking system that you create and develop, the better off you will be financially. Better financial situations then create better situations that ripple throughout your life. That's the whole idea of everything. But today, we're not going to talk so much about the life benefits side of things and the benefits that we expect and nurture with the infinite by practicing the infinite banking concept. We are going to go back to basically the fundamental foundations of life insurance, and that is premiums paid for death benefit that is then offered. We want to focus in on the death benefit. How do you calculate how much death benefit you need? That is a common question when people go to buy life insurance because it is relatively inexpensive to get large amounts of death benefit, especially if you're young and healthy. So, is more better? Is there a certain number you should stop at? Since you can afford a lot of it, should you get a lot of it? Or should you try and sort of self-insure, put some of that money away somewhere else and just skate by with the smallest amount you need? Those are all fair questions. Those are all things that people think about. And today, we want to bring light to that situation. It's not clear-cut, unfortunately, or fortunately as the case may be, because you can't just look at your life and say, how much responsibility do I have? And determine that if you have an 8.5 responsibility level, then you need a 6.2 of life insurance death benefit. It just doesn't work that way. This is more of a spiritual, if you will. Money tends to be a little bit more spiritual oriented as to physical oriented. And what I mean by that is that your needs can change based on situation, based on people, based on the situations of the people that you're responsible for, based on your profession, based on what you do to provide value, whether you're paid by the hour, whether you're paid by commission. All of these types of things are all factors, and you can't necessarily put your glasses on and take a good look at them because they don't exist in a physical realm. And that's what makes them sort of more spiritual than some other things. For example, you could take 2 pieces of chocolate, set them on your counter, and then you can set 2 figs right beside them, and you'll know that you have 4 items there. You can see that, you can count that, you can verify that, you can do the math and add that up. You cannot set your talent on the counter and count it. There's no way to do that. And since you get paid based on your talent and how you apply that talent, then the gratitude or the gratitude certificates you receive from that, which we also call money that can be traded and used for other things, are also somewhat spiritual in nature because they have a way to relate to your talent that is not necessarily quantifiable. And so, again, we are dealing with that in terms of death benefit too and how much you need. So, although we aren't going to be able to come out and say, you have an 8.5 responsibility, that means a 6.2 in death benefit, we are going to be able to give you a lot of helpful ways to think about it and hopefully helpful ways to plan so that you can make sure you are happy with the amount of death benefit you acquired during your lifetime. All right, that is a long introduction to a podcast about death benefit, but I hope it's helpful, and we are going to jump right in and kick things off. I want to ask you, John, first off, since you do a lot of this financial planning for people, as an investment advisor, what are some of the first things that you are thinking about when you are helping somebody determine how much death benefit they need?
There are different approaches that we can take to calculating the death benefit. So one of the first things I'm usually thinking about is based on the questions that people are asking. And when somebody comes to me who's 50 years old, they know that death benefit is going to be more expensive than when they were 30 years old. And so a question I'll often get is, well, should I put the policy on somebody who's younger than I am? Because they know the death benefit is going to be higher for a younger person than for an older person. And since we're often talking about the living benefits of a life insurance policy, they're assuming that because the death benefit, they know the death benefit is going to be better for a younger person. They're assuming the cash value will be as well. And that's actually a nice surprise for a lot of people when they're looking at the numbers. The cash value for a 50-year-old is not that different from the cash value for a 30-year-old. And so when we're talking about living benefits of a policy, when we look at the cash value numbers, there's actually a period of time where a policy that's designed for a healthy 50-year-old compared to a healthy 30-year-old, there is actually a period in the middle years of those policies. I don't have the exact years off the top of my head, but the cash value growth is going to be more efficient for a 50-year-old.
In the older person's policy.
In the older person's policy.
Yeah,
it doesn't mean that dollar for dollar it's going to be higher, but based on the dollars going in and the dollars that are showing up in cash value, there is a period of time where it's going to be a little more efficient for the 50-year-old.
So if somebody's wondering, should I get an infinite banking policy on somebody younger just as a cash value? The answer is not necessarily at all.
Not necessarily, no.
So we're talking about more the death benefit side of things today. So I would like to find out from you if somebody has a certain number of assets, certain number of, dependents, and they have retirement in mind at a certain age, so they don't want to be paying premiums on this life insurance anymore. What are you thinking about to help them determine the amount that they should have in death benefit? Because if we're looking at the life benefit side of things, basically you want to get as much as you can comfortably afford, because that's just going to make your investment side of things better and the way you use your infinite banking system. Death benefit, though, what are you looking at to calculate that?
So when we are thinking about the death benefit, I will usually start with someone by thinking about the cash value, like you were talking about. What about the living benefits? And that's going to have a death benefit that's associated with it. So that's part of the death benefit equation. Once we have the savings side figured out, then we can see how much more death benefit do they need to cover their family.
Okay, that's what I'm getting at. Exactly. How much death benefit cumulative do they need?
There's different ways to approach that. So the life insurance companies, they're looking at this from an underwriting standpoint. So they tend to look at, okay, how much income are you making? What's your age? And then they have a multiplier that they use on top of that. So for instance, if you're 18 to 40 years old, they might take your income and multiply by 30 to have the maximum amount of life insurance coverage that you could have.
Okay. So somebody making $100,000 could have $3 million of death benefit.
Whereas somebody that's over age 60, it might be a multiplier of 5 times their annual income.
Right.
to create the maximum amount of death benefit. Now, remember the life insurance for the 60-year-old is going to be more expensive on an annual basis than it would be for the 20-year-old. So that's one way to think about the death benefit. Another way would be to calculate a basic human life value. Sounds terrible to say it that way. But basically, that is thinking about what is the earning power of this person over their career. How many years do they have left in that career? And then trying to buy enough death benefit to replace those years.
Okay.
That's another way to do it. That's a quick rule of thumb as well. I prefer to use what would probably be termed a family needs approach, where we add up all of the debts that you would want to be paid off if something happened to you, where we add up the expenses that your family would continue to have for lifestyle, for education, for their future needs, maybe your spouse's retirement, where we add those up, apply a rate of inflation that we need to assume, and then calculate how much would you need if you passed away today to cover those expenses. So I feel like that's a more specific approach, but sometimes being more specific, you'd rather overshoot than exactly hit that number.
Sure.
So I like to be precise about it and then add a little bit of a buffer and zone in there.
Like anything in life, I think that being more specific and really drilling down and get the answer like that is going to require a lot more work.
It does
to
require
go through
some extra effort.
And do that. And it requires more time to be spent thinking about something that a lot of people don't like to think about, and that is our eventual exit out of this place, which we all have to face at some point. Naturally, we don't want to think about it a lot in advance, but it's important to think about that in advance, not only from a financial perspective, but especially about where you'll be going after this life. The most important thing you can think about. So from a financial perspective, people don't really like to think about it, and I don't blame them. Who likes to think about when they're going to die and leave all the people they love and the things they enjoy in this world? It makes sense. However, if you can discipline yourself to think about these things that John just talked about, like your earning power that won't be there for the people you love, if you are thinking about your future obligations, and if you're thinking about the people you leave behind and what kind of situation you want to leave them in, if you think about those things a little bit more and in detail, and really take the time to be disciplined and add those things up, you can probably come to a pretty accurate number on your own. Now, things to think about that might not be immediately obviously, John mentioned one, that is inflation. Inflation is going to continue happening. We don't know at what rate, but if the past is any indication of the future, you can bet your bottom dollar it's going to continue. And so you want to make sure that the time period that you're looking at providing for those that you leave behind they're not going to get hit with inflation as hard because of the planning that you have done in advance. So make sure you add that in there. Something else you may consider is also earnings rate. How long can you make the principal last by oversizing it, essentially, so that the earnings rate will be more significant on that. All things that you want to think about on that. And then, Stephen, one of the common sayings in the financial planning world is you will get to an age where you no longer need death benefit. What does that mean exactly? And do you think that's good planning?
Well, what it means is you will come to an age when the house is paid off, the kids are gone, and you don't have anybody that is dependent on you anymore. So you don't need a death benefit because the death benefit is not for you, it's for those you leave behind. So if all your dependents are gone and you don't have any debts, why do you need the death benefit? And that checks out from a logical standpoint. However, that's not what we see. We see a lot of people reach that age with the kids grown up and gone and the house paid off, and they still want a death benefit because they still want to leave something behind. They want to leave the next generation better off than they were.
Very honorable.
Yes, very honorable.
And sometimes they still need a death benefit from an asset perspective too. So maybe they thought they wouldn't need a death benefit by age 60, but sometimes they still do.
Yeah, that's true.
For some obligations they have for their spouse, for the future earnings. Yeah.
And that was the whole argument with term insurance. With term insurance, you'll get it for a certain number of years until the kids are gone, until the house is paid off. and then the term insurance goes away. Well, at that age, regular insurance, whole life insurance, becomes much more expensive and it's much harder to get. And that's what a lot of people are finding out. Now that they get to that age, they would like that insurance, but it's much more difficult to get.
That's true. And one of the things that scares people off from getting that permanent death benefit through a whole life insurance policy initially is the size of the premium to death benefit ratio. When you could buy term insurance that should cover you until, and I'm doing air quotes for those of you listening, until you don't need the death benefit anymore, the term insurance makes absolute sense on paper. However, if you get to that age and you still want life insurance for some reason, and here's a few reasons if you can't think of anything, when your child with their children comes and returns to live back at home. I don't need to make up a scenario for that. You probably know somebody in that situation. I know several people that has happened to. It's very common right now for some reason for a grown adult child to return home and bring some of their offspring with them. If you have extra expenses associated with that or extra expenses that will be associated with that you want to take care of, you may still want a death benefit. Another one is sickness. Sickness can cause things to go haywire, and that can be very expensive, and it can not only require money out of pocket, but it can also destroy earning power. Now, this sounds very mercenary, and it is because we're talking specifically about finances, but that is what our job is in this podcast episode, so that's what we're going to do. There's other situations also, hardship situations of aging parents. They may need a lot more care than you factored on. And you want to provide that, right?
Yes.
And so if you have to drain some of your assets to do that, wouldn't you want those assets replaced if you were to die and leave your spouse with the depleted assets? I'm not married yet, but I certainly would.
Yes.
If I was married.
Those are things that you can't plan in advance. So it makes sense to carry a little bit extra death benefit, more than you think that you're going to need.
And permanent death benefit.
Yes.
To your point, Stephen, people don't need this, quote, but do they want it? Oh, you bet they do.
And I think part of the problem is, first, people don't look far enough in advance to see there's some potential problems up here. But then the other part is, and this is partly policy design, they don't look far enough in the future to see, with a well-designed policy, I will have more in the future in cash value than I've ever put in. So it's forced savings right now, but in the future, you can reap that reward. You can take that out, or you can turn it into an annuity that gives you guaranteed income for life.
You're right. It does. Over time, whole life insurance, the cost of whole life insurance disappears if you look at total premiums paid versus cash value that you can access. For like you're saying, you could either just pull it out if you wanted to. That's okay. Or you could turn that into guaranteed income for the rest of your life with annuity. And that's fantastic. Or you can continue to just borrow and pay back that cash value as you use the money for business and to invest and to grow it. It really leaves your options on the table. And this whole time you can have death benefit. When you get to an age where your term insurance would normally expire and lapse, and it's way too expensive to renew, we're talking about premiums that are almost the size of your actual death benefit at these ages in term insurance. You can decide to reduce pay up your policy if it's not paid up already. And what that means is that for this whole life insurance policy you've been paying premiums for over the years, you decide, I don't want to pay premiums anymore. Let's just reduce the death benefit a bit so that it requires no more premiums, and then just let it chill. It'll be there for you, and it'll stay there for you.
Yeah, and sometimes it's not even just based on age, because I was working with a guy the other day. His term insurance is coming up. It's going to be expiring here in a few years, and he wanted to see about extending that. So we looked at a new term insurance policy. This guy is in his 60s now, getting close to 70, I think. And he wanted to extend this term insurance for another 10 years. We were looking at it, it could be a couple $1,000s a year to do that. And he was thinking, okay, it's probably worthwhile. But then he went through underwriting with the insurance company, and he is rated Table E.
Oh, no.
So now that insurance is going to be like 5 times as expensive.
So we're talking
probably not.
We're talking about $10,000 a year instead of $2,000 a year.
Yeah. Well,
Yeah.
it's actually it was closer to 17,000 a year, I think.
Oh, that's
Probably more than 5 times.
way more than 5 times. Yeah.
For those
Fine.
of you who are not aware of the rating systems an insurance company use, what John is talking about, level E, he was rated at. So an insurance company, they do the physical exam and they look at a person's overall health, and then they give you a rating. There's preferred plus, preferred, standard, and then I think it goes right into the tables from there, doesn't it? So you
Yes.
have table A, B, C, D, E.
Or sometimes they'll call it table 1, 2, 3, 4. Yeah.
Okay, so sometimes they'll have
Depending on the
numerical
company.
tables, but level E means you're pretty high risk to the insurance company for death. And so they're going to charge a lot more in premiums. So when you get a rated case like that, the premiums change drastically.
Death benefit amount on that policy you were illustrating, do you recall, on that term policy? For this gentleman in his 60s going
I'll
into
say it was
70s.
500, but I don't recall for sure.
About 500,000, you're thinking?
I think it was around 500,000.
And $17,000 a year to maintain that.
It's pretty high.
Yeah, it is.
I
It's not
have
like you didn't die the first year and you regret this and you say, okay, go ahead and refund me, and they give you $15,000 back.
No,
Does not work that way.
you're out of pocket, and that you think about that. That's every year for the next 10 years.
Yeah, $170,000.
That's pretty high.
Yeah, that is pretty high. So there are a number of ways that you can calculate how much death benefit you, quote, need. And I say need loosely because obviously you don't need death benefit. The only things we need are really food, shelter, water, clothing, that kind of stuff. Those are the essentials. But how much do you want? And the answer might be more than you will be allowed to have because of those factors that John shared with us about. They have an income multiplier. So like 18 to 30, you can multiply by, or 18 to 35, you can multiply by 30. Maybe once you get a little bit older, you can only multiply by 15, then only by 10, et cetera, et cetera. And you take your income number, you just multiply it by that factor. That is sort of the I say hard limit, but it's not a hard limit completely because underwriters can look at people's certain scenarios and make exceptions to that. However, those are kind of the loose bounds of what you can work with. And so if you just, you can probably look this up online. If you just say, how much death benefit can I have based on my income and my age? It should pull you up a multiplier table so you can see that. And then you can just take your income and you can look at your age, find out what the multiplier is, multiply those two together, and that'll answer your question, how much death benefit can you have? Once you have that figure, then you could work backwards off that. But I'm a big fan of the way that John describes doing it, and that is looking at your liabilities. What kind of debt service payments might you need on your mortgage, your cars, any consumer debt you have, hopefully none, and any investment debt you may have. What kind of lifestyle do you want to be able to provide for your family if you were suddenly taken away? And just kind of think about what that monthly expense might be over a given number of years. Definitely make sure that you add the inflation in there once you start projecting out over a few years. Look at what kind of earnings rate you might be able to reasonably expect. I say reasonably because there is a voice in the financial industry who advocates for term only and projects very unreasonable rates of return. Some of you may know who that is.
Listen, man, the math I just gave you is the math. If you're making 12% and inflation is 4%, and you leave 4 in there, so your nest egg grows by 4, it's simple. 8 is what's left over. So if you got $1 million and you leave 4% in there, that's $40,000. Okay, so you now have $1,040,000. So the next year you get a rate of return of 12%, 11.5% on the $1,040,000, and the next year it'll be $1,090,000, 1.1, right? Because your nest egg is growing by the rate of inflation, giving you a cost of living raise every year. So as long as you're doing that, you're fine.
I don't want you to do unrealistic expectations on the return side. You're trying to be as realistic as possible. If it's worth doing, it's worth doing right. This is going to take a little bit of time. So be as practical as you possibly can be because you want the real answer of how much death benefit you're going to need. Again, I say need loosely, okay? put all of that together, and any education, children education, any funds you would like for them to have to get started in life, anything you'd want to take care of your spouse in addition to what you already have in place, those kinds of things. Put all of those on a paper, or however you're going to make this addition problem work. Add them all up. It's about as simple as that. Take a look at that number. Take a look at the number you arrived at by your income multiplier. Are those numbers compatible? If they are, and if you still have room in your income multiplier, maybe just for feel goods, you want to, add $1 million on top of that, or $500,000 on top of that, or $100,000 extra on top of that. Whatever it is, I would encourage you to find those realistic numbers and then hang your toes over the line a little bit. Make it a little bit better than that, because we're not prophets. We don't know the future. We can't predict the future. So something's going to come along that changes that a little bit. And I'd rather the change not hurt. You know what I mean? So everything's taken care of and a little more besides, versus everything hopefully being taken care of, but maybe not quite. That's what I like to think about in terms of calculating your death benefit.
Something I would like to mention before we sign off on today's show. A lot of people think that a death benefit is more expensive than it actually is. And so it might be helpful just to know for the 30-year-old can get $500,000 of term insurance coverage for only $325 a year, or about $28.16 a month. If they're a healthy 30-year-old, 20 years of term insurance, $500,000, that's a pretty good rate for it. A 50-year-old for the similar type of policy with a similar health condition is going to be about $96 a month, about $1,100 per year. So very, very reasonable term insurance rates. Now, whole life insurance rates, $10,000
are even better.
Premium, because you get the funds back for it
Over time.
right? But it's going to be a little bit higher initially.
It's going to be a higher outlay, yes.
If you put $10,000 into a whole life insurance policy on a healthy 30-year-old, you're going to have about $295,000 of death benefit initially. That will grow over time, but by year 7 to 10 in that policy, you're going to have everything back that you paid in premiums and cash value.
You're going
That's
to have
pretty
everything available in cash value.
Yeah.
And you can either take that back and say, okay, I netted zero or I made money on having a life insurance death benefit, or you can just leave it there and you can leverage it and use it to invest in.
Exactly.
Yeah.
And for a 50-year-old, that similar type of policy design is going to be about $200,000 of death benefit initially. And it's going to take a little bit longer to break even, usually about 10 to 12 years instead of...
It still happens.
10.
It just is a little bit delayed timeline.
Exactly.
Because of the risk that age of person would pose to the insurance company.
Exactly.
Yeah.
So a good strategy is to start with your whole life insurance, figure out how much you want to be putting away, and think about the cash value as part of your savings and investing strategy. Think about the living benefits. Then take the death benefit into account on your permanent insurance and add whatever you need in term insurance on top of that to protect your family the way you want for the future.
We just got an email that somebody has been paying premiums on their whole life insurance policy for some time now. They made another premium payment, but they look at their cash value amount and it is not equal and definitely not greater than the premiums that they have paid over this period of time. And they were wondering, why isn't the math adding up? Shouldn't I have as much cash value as I have paid in premiums? It's a good question. We answered the question via email, but for the benefit of all the people who listen to the Wealth Talks podcast, we want to answer this question next week
Right here
on Wealth Talks.